Hey everyone, welcome back to the channel. If you're looking to build passive income streams, you've probably heard the buzz around two major things right now: artificial intelligence and high-yield ETFs. Today, we're diving deep into an investment that sits right at the intersection of both. We're talking about the REX AI Equity Premium Income ETF, ticker symbol AIPI. This ETF has been grabbing headlines for its eye-popping dividend yields, making a lot of income investors ask, is this the golden ticket to riding the AI wave while getting paid cash every single month? This fund is offering something that sounds almost unbelievable: a 35% annual yield. That's not a typo. 35%. To put that in perspective, if you invest $10,000, you'd receive about $3,500 in distributions per year. But before you rush to your brokerage account, we need to talk about how this actually works, what you're really getting, and the serious trade-offs involved. In this video, we're going to pop the hood on AIPI. We'll look at exactly how it generates that income, its top holdings, its performance over the last year, and most importantly, the real benefits and drawbacks you need to know before putting a single dollar into it. Before we start, this video is for educational purposes only. It is not financial advice, not investment advice, and not a recommendation to buy or sell any security. Investing involves risk, including loss of principal. Always do your own research and consider speaking with a qualified professional. So what exactly is the AIPI ETF? In simple terms, AIPI is an actively managed fund that gives you exposure to some of the biggest names in artificial intelligence. But it's not just a standard buy and hold fund. It has a twist designed specifically for income. The fund uses a two-part strategy. First, it invests in artificial intelligence stocks, companies like Nvidia, Palantir, and Crowdstrike that are leading the charge of the AI revolution. Second, and this is the key part, the fund sells call options on those same stocks to other investors. When they sell these options, they collect a cash payment upfront, called a premium. It's this premium that funds the massive monthly distributions paid out to shareholders like you. The goal is to provide high current income, with a secondary goal of capital appreciation. But as we'll see, that second goal comes with a catch. First up, what are you actually buying? As of the end of 2025, the top 10 holdings in AIPI include some very familiar names. We're looking at Nvidia, Palantir Technologies, Crowdstrike, Datadog, ARM Holdings, Micron, Arista Networks, Salesforce, Adobe, Synopsis. It's a who's who of the AI ecosystem. Notice something important here: the top 10 holdings make up about 55% of the entire fund. And beyond that, you've got Apple, Intel, Meta, IBM, Microsoft, and AMD. The fund holds about 98 total positions, but it's heavily concentrated in technology stocks. In fact, over 90% of AIPI is invested in the technology sector. This is pure AI exposure, which brings both opportunities and risks that we'll talk about in a minute. Now, for the price and dividend data that everyone wants to see. Closing price. As of 12/31/2025, the fund finished the year trading at $40.35 per share. Total annual dividend for the last 12 months. Throughout 2025, the fund paid out a total of approximately $15.16 per share in monthly installments. Total assets under management. The fund has grown to over $408 million in assets under management, with strong investor interest driving $319 million in net inflows over the past year. Annual dividend yield for the past 12 months. Based on that price and payout, the trailing 12-month dividend yield sits at an incredibly high 37.6%. That yield is what grabs everyone's attention. But now let's look at the trends over the last year, because yield isn't everything. Price trend for the last 12 months. Over the course of 2025, AIPI's price action was volatile. It hit a much higher level earlier in the year with a 52-week high above $50 and finished 2025 around $40, trending downwards. Dividend trend. For the last 12 months, the dividend payments have been consistent in terms of frequency. You get a check every month. However, the monthly distribution amounts were variable, but also trending downwards. In 2025, they ranged roughly from about $1.45 down to $1.10 per month. The dividends trended downwards. Why? Because those option premiums depend on volatility in AI stocks. As the market for these stocks stabilized throughout 2025 and volatility diminished, the option premiums also diminished in turn. Something important to consider. When you account for both the payout distributions and the price decline, the total return for 2025 was actually positive, around 17 to 20%, depending on the exact measurement period. That's actually better than the S&P 500 did over the same time frame, which was about 16%. But here's the catch. If you're spending those monthly cash distributions instead of reinvesting them, you're watching your principal slowly shrink. This is a critical consideration for retirees or anyone depending on this income for living expenses. Okay, so why would someone want this in their portfolio? Let's talk about the benefits. 1. Massive current income potential. The primary draw is obvious. That yield. A yield in the 30 to 40% range is unheard of in traditional fixed income or dividend stocks. For investors focused purely on generating maximum cash flow right now, this is a very powerful tool. 2. Monthly cash flow. Bills come monthly, so getting paid monthly is a huge plus for passive income investors. It simplifies budgeting and reinvestment. 3. Exposure to the AI theme. You get to participate in the AI megatrend without having to pick individual winners and losers. You hold a diversified basket of the top players in the space. 4. Lower volatility than underlying stocks. Because the covered call strategy brings in cash premiums, it can sometimes provide a slight cushion when stock prices fall. The fund may not drop quite as hard as a pure holding of Nvidia or Palantir during a sharp sell-off, but it will still drop. Now for the reality check. High yield always comes with high risk. What's the catch? 1. Capped upside, the big trade-off. This is the most important thing to understand. By selling call options, you are agreeing to sell your winning stocks at a certain price. If Nvidia doubles in price in a month, AIPI investors won't participate in all those gains because the upside is capped by the options contracts. You trade future growth for current income. 2. Price erosion, also known as net asset value decay, or NAV decay. Remember that price trend we looked at? The share price dropped significantly over the last year. This is a common issue with high-yield covered call ETFs. Sometimes the dividends they pay out are greater than the capital appreciation they can capture, leading to a slowly shrinking share price over time. You might be getting great income, but your original investment principal could be shrinking. 3. It's not free money. The high dividend isn't magic. It's compensation for taking on risk and giving up upside potential. In a roaring bull market for AI, a simple index fund might vastly outperform AIPI in total return, even without the high yield. 4. Sector concentration risk. This fund is all in on tech and AI. If the tech sector takes a hit or the AI bubble bursts, this fund will suffer heavily. There is very little sector diversification here. To wrap it up, AIPI is a specialized tool. It should not be a core holding for a long-term retirement portfolio that's focused on growth. It's designed for income-focused investors who are bullish on AI but are willing to sacrifice future capital gains in exchange for massive immediate monthly cash flow. The key is to look beyond the yield. You have to ask yourself, Am I okay with my principal potentially going down in exchange for that monthly check? Do your homework, understand the covered call strategy, and make sure it fits your personal financial goals. Thanks for watching. If you found this helpful, hit that like button and subscribe for more deep dives into passive income investments. See you in the next video.